Hello, everyone. Thanks for joining us this morning. I think we got a really good topic to discuss today in municipal bonds. Certainly one that we'll often see in the headlines and that gets lots of views and attention on social media due to its tax-free income. And tax-free is sure to grab some eyes and get some clicks because who doesn't want to pay, who doesn't want tax-free income, right? So certainly understand the interest and maybe you've heard some chatter about municipal bonds. So let's talk a little bit about it and explore them a little bit further. And I guess I would say that I think the discussion on the topic of muni bonds is timely because there seems to be a lot of questions right now about, what to do with your money, right? If we rewind the clock a bit, just a couple years ago when interest rates were super low, almost zero, basically. I remember being considered lucky to get a CD that was yielding 1%, right? So because rates were so low, a lot of people were sitting on their cash. And as you guys are aware, rates increased pretty significantly in short order to try to slow down inflation. And following those increases, everyone started to put their cash to work, and rightfully so. We preach doing the same. So fast forward back to today, interest rates have started to come down a bit from their peaks. The Fed just announced a 0.5% rate cut here recently. We anticipate that trend of rate decreases to continue going forward into the rest of the year and into next year. And with those rates coming down, maybe you're looking at moving out of some high yield savings accounts, or perhaps you have some CDs or treasuries that you locked in when rates were high, and those are starting to mature now or in the near future, and you're anticipating your yield on those to come down as a result of interest rates coming down. And so maybe you want to explore some alternatives because you like getting that higher yield, and the 5% you were earning was nice, and you've kind of grown accustomed to that. And so maybe muni bonds are a good fit for you, and we can be a substitute for some of those funds. So I know personally a lot of my clients are very tax conscious, and so they're always looking for ways to pay less tax. So nobody wants to pay more than they have to, right? So one way we can potentially do that is municipal bonds. So you're probably thinking they're tax free. Well, why isn't everyone using municipal bonds? And so hopefully by the end of this webinar, you'll have a little bit of clarity on why they might be a good fit for some, but not necessarily all. So really today, what we want to explore is, kind of what exactly are municipal bonds, and gaining an understanding of how they work. What are the different types of municipal bonds? What are some of the associated benefits of municipal bonds? We've already talked about how they're tax-free, right? But certainly other benefits as well. So we'll take a look at that. We also want to kind of address some of the risks. It's important that we understand what risks they present. So I think our hope is that, we can help you identify whether maybe they're a good fit for you potentially. And if they are, what are some strategies for owning muni bonds in your portfolio? Okay, so what does it look like in terms of investments in your portfolio? So, in order to help you make that determination of whether they're good or not, we need some tools to help evaluate the various bonds, because some are tax-free, some are taxable. And there's a lot of different ones out there with different yields. So we want to be able to evaluate and compare them on an apples to apples basis. So we're going to dive into that a little bit and walk through an example of how to compare two bonds. So a lot of good stuff to get to today. Before we jump into the meat of our discussion, I just want to take a minute to introduce myself and allow my partner Trent to do the same. I guess I also just mention that, we understand that sometimes investments can be daunting and scary and overwhelming. Our hope is that we can shed a little bit of light on this topic. But certainly if you have questions that extend beyond the scope of the webinar, feel free to reach out to us or any of our wealth consultants on our team. We're happy to help. If you do, like, Jesse mentioned, if you do have a good general question, I would encourage you guys to use the Q&A. There's no dumb questions. And so if you're seeking clarity on something, no doubt there's at least one other person on the presentation today wondering the same. So we're not really in the business of guarantees, but I've never seen Trent be stumped. So fire away. Okay, so let me introduce myself. My name's Jude Fox. I'm a wealth consultant and a CPA here at Adams Brown. I work out of our Hayes office in Western Kansas. In addition to being a CPA, and that's actually where I started when I joined the firm. I hold my personal financial specialist designation, PFS, and that basically allows me to kind of broaden my scope of expertise into kind of financial planning and wealth management. And that's important because tax and financial planning, they're just so inherently and necessarily intertwined. So while I'm a CPA and I maintain my license, my primary focus is wealth management. So we're here to help our clients and give them peace of mind that we're kind of taking care of that piece of their life for them. I didn't mention this earlier, but we'll have our contact info at the end of the presentation. So if anybody needs it, they have it. So Trent, why don't you tell us a little bit about yourself? And then if you would, maybe provide a little bit of background on Adams Brown Wealth Consultants and our approach to helping our clients and what makes us unique.
Thank you, Jude. Yeah, appreciate everybody coming on this morning and joining us for this 45 minutes to an hour and learning a little bit more about maybe something you don't know about. And I'm excited about today's topic. I really like the strategy used. I love talking to clients about it, and I do get we get a lot of questions on it over the course of time. So like Jude said, I'm one of the other advisors here with Adams Brown, and I am a CFP, which is a certified financial planner. So we do everything from full retirement planning to estate planning to risk management for insurance strategies. And so we try to do that holistic plan for clients. I've been here now 7 years with Adams Brown. It's gone by fast. I've been in the industry a couple more years than that, but really just enjoy really working with clients like some of yourselves that might be joining in, and just looking at different strategies that we can optimize for tax efficiency. So if you are joining us for the first time or don't know about Adams Brown, we are a wealth management firm tied in with the accounting firm, spread across Kansas and Arkansas. And we have 13, 14 offices. We have 12 advisors now, and that work within those different offices. I work primarily in the Hutchinson office. You'll also find me in the McPherson office frequently. And again, we strive to provide that holistic plan for our clients. And if we need to bring in the CPAs and the team, whether it's attorneys, to walk through you with your plan and get you through those steps for all that planning, we certainly do that and take advantage of that opportunity for you and walk you through that. So, all right. As we get into this, first question we need to cover: what are municipal bonds? Okay, so the easy thing to think about is it is municipality, right? That's going to be your state, county, or city. They are going to issue a debt security to finance a project. Now, most common, we think of schools. And that's when we see in the headlines in the newspapers. There's going to be also other projects that they might do, whether it's highways, bridges, toll roads, hospitals, airports. Those are some of the most common ones we see. Now, the way this works is they issue a bond for a certain amount of debt. Let's say it's 30 million. Okay, you as an investor can come in and then purchase a bond to help finance that project. Now, if you and I were looking to need some money or some capital for a project at our house, we would just go to the bank. Well, your states and local governments can't do that, so they turn to investors to finance projects. And this is where you as an investor get that opportunity to come in and take part of it and earn a little bit of income, probably going to be tax-free to some degree, and you keep your risk down than you do from being in the stock market or the equity market. And so, again, bonds are not equities. That's the thing to keep in mind. They're usually more conservative investments. Okay. So, types of municipal bonds. There's two types that we generally think about: general obligation bonds. We call them GO bonds, and I'll refer to that for the rest of this seminar, and revenue bonds. Okay. General obligation bonds are backed full faith and credit by the issuing government. Again, I'm going to use the school example. When a school issues a bond, most of the times it comes back in the form of taxes. They raise taxes in some way. Okay, that is backed full faith and credit by the local city government. Revenue bonds are backed by the specific project and how that's being used, whether that's a toll road, whether that's a hospital, might be an airport. As long as people are using that project, it's going to get funded back. Okay, and there can be some risk with both sides, and I'll talk about that a little bit more. Okay, how municipals work. Again, I gave the example, a $30 million bond. You get to go in as an investor and purchase bonds, and what they're going to give you in return is income, federal tax-free and potentially state tax-free. And that is going to, again, you're trying to maybe beat the bank or reduce your taxable income by earning interest that is tax-free. And so we're going to, use the example, if they're paying back 5%, okay, and you buy $100,000 in a school bond, you're going to earn $5,000 for that year in interest tax-free. Okay, so great strategy that I love talking with clients about. And one thing that we need to be sure to address: municipal bonds are primarily used for taxable accounts, not IRA accounts. Okay, that's something very important to keep in mind. There's another type of bond, corporate bonds, that will use in IRA accounts. Okay, municipal bonds, they are used in after-tax accounts. So that is very important to keep in mind as you think about this, if this is a strategy for you. Okay. Covering back on the two types of bonds, there is general obligation and the revenue, like I talked about. You are primarily going to see more revenue bonds out there than GO bonds. And we gave the pie chart up here, 68% to 28%. And your revenue bonds, again, are going to be hospitals, airports, utilities you might see, versus the general obligation bonds. Now, one thing to keep in mind is revenue bonds usually carry a little bit more risk than GO bonds. But with that, you might get a higher yield. That would mean more income for you if you're taking on a little bit of risk. Like Jude said, every investment has some sort of risk, and bonds, municipal bonds, certainly can vary with their risk. Now, how that risk is gauged is credit rating. And bonds will have anywhere from a AAA down to a D rating. AAA meaning the best rating, and B is a little bit lower, and C. And so your AAA, AA, single A bonds are going to have less risk. Okay, so that's more likely that it's going to be paid out over time. That and you're reducing your risk down than you would from a C bond or a D bond. And he might hear the term junk bonds. So normally when we talk about bonds, we talk about investment grade. That's anything triple B or above. Okay. All right. So bonds do have benefits and risks. Jude's going to touch on those here in the next couple slides. And take it away, Jude.
Yeah, so let's talk about some of the benefits that municipal bonds can provide. We already touched on this a couple times, but perhaps the biggest is just the tax advantages, right? And so interest related to muni bonds is almost always federally tax exempt and can also be exempt from state and local tax. So it's possible that you pay absolutely no income tax on the interest that you're earning in a muni bond, which is a really, really good deal. So we'll touch base on why a muni bond may or may not be exempt from state tax as well a little bit later. So Trent mentioned this earlier, but one key item I want to make sure everyone understands today, that if in order to fully benefit from those tax advantages, the strategy doesn't work as well in an IRA, right? Because we're not taxed on the money in an IRA until we take it out. And when we take it out, we don't distinguish between, income earned on a taxable bond or a municipal bond or a CD or whatever. It's all 100% taxable when it comes out, no matter the source. So to take advantage of the muni bonds, we need to hold those funds in an individual account or a joint account or something like that. So keep that in mind. All things equal, we like muni bonds more in individual or joint accounts than we do in, say, an IRA or a 401k. So another benefit is safety and stability. So muni bonds are considered to be relatively safe on the spectrum of investment risk. Treasuries, those are basically debt issued by the federal government, and they would be what we consider the risk-free rate of return, the safest. But muni bonds would probably be right below that in terms of safety. And the reason they're so safe is because, as Trent mentioned, the issuers of those bonds have the authority to levy tax. Okay. And that's a great safety net if push ever comes to shove and meeting debt obligations becomes difficult, right? They always have that ability to impose tax to generate additional revenue. So each state, for instance, is rated by these rating agencies, just like a corporation would that's issuing a bond. So, agencies like Moody's, for instance, they'll rate each state to help investors kind of evaluate their ability to kind of meet their debt obligations. And so, at this time, all the states would be considered investment grade, which means there's, minimal risk to investors. Another good benefit is income generation. So for our clients that are wanting their investments to start providing income for them in retirement, muni bonds can be a great source of providing that income. Generally, the issuers of the muni bonds, they pay interest on a semi-annual basis. And so we like that if we need cash to provide for our standard of living, because we don't have to liquidate any positions in order to provide that income. And so we can count on it coming on a specified timeline, and we kind of know how much we're going to receive. Okay. And that's different from like a stock that's paying dividends, right? Companies can increase or decrease their dividends as they please. And some of that depends upon profit. So there's no assurance that they'll continue into the next quarter or next year. And so we like the reliability that interest from muni bonds can provide. Diversification. So we preach diversification a lot as wealth advisors. Maybe you've heard that word before, maybe you haven't. If you haven't, in essence, what it means is that we don't want all of your investments doing the same thing at the same time. Okay. That's dangerous, frankly, especially in scenarios like I just mentioned, where, we've started to lean our investments to provide us with income. So instead, we want to own investments that aren't necessarily correlated to one another. And when we do that, what we've done is minimize the range of investment outcomes that we can have in any given year, for instance. And that can be critical in helping sustain income and investment balances when the market's down or there's wild swings back and forth going on. So I guess even if you leave this webinar with the conclusion that muni bonds, might be a good fit for your personal situation, I guess I maybe do want to clarify that we're not necessarily suggesting that you move your entire portfolio to muni bonds or that you put all your cash in muni bonds, right? That could be a prudent strategy, but it's more likely the case that, your overall portfolio could use some diversifications beyond just muni bonds. Preservation of capital. So I touched on this a little bit just now when we were talking about diversification, but muni bonds are typically less volatile than other investments, which again can help minimize those range of outcomes. Sometimes our clients' portfolios, they need to provide stability, and we don't want to see those large swings in our investment balances, even if it comes at the expense of return, right? That's an okay trade sometimes. So, and as we know, as long as the issuer doesn't default, we can expect to receive our principal back upon maturity. Okay, so lots of good reasons to own municipal bonds, right? But let's also understand, some of the risks associated with muni bonds. Okay. So credit risk. So credit risk is the risk that the issuer, whether it's a state or city, is unable to meet its interest and debt obligations. So that could result in a default. And default can happen for various reasons. Normally it's financial health deteriorating, economic conditions, or changes in government regulations. Default rate on muni bonds is honestly really quite low. It's happened before. You probably remember the city of Detroit, or the Commonwealth of Puerto Rico. Small risk, but one that we definitely want to consider when we're determining, which issuer we want to use. Interest rate risk, we've seen exactly how this works with bond prices here recently. If you own bonds in 2022, you saw firsthand how that works, unfortunately. So, and to be clear, interest rate risk is a risk for all bonds. It's not specific to muni bonds. In fact, that's true of all these risks that we're talking about. These are general bond risks and not specific to muni. So, but interest rates and bond prices have an inverse relationship. So as interest rates go up, as they did in 2022, existing bond prices go down. Okay, and so the inverse is true as well. So we want to be cognizant of where rates are at currently and where we think they're going, because they can have an impact on prices. Market risk. Okay, so market risk is the risk that the muni bond market prices will decrease as a result of economic conditions or political events or what have you. That's a little bit different than credit risk, where the ability of the issuer of the bonds might change over time. Market risk is different. Those are external events. Okay, so imagine the U.S. declared war on another country. The ability of the state of Kansas, for instance, to repay its debt obligations maybe hasn't changed at all, but maybe the threat of a global war might cause a decline in bond prices temporarily, just because people are nervous. So, I mentioned one of the earlier benefits of muni bonds is preservation of capital, and while that's true, and it's less volatile than other investment options, it still carries a little bit of market risk. Last one here, liquidity risk. And that's just the risk that if your bond needed to be converted into cash, there could be difficulty in selling at fair value due to limited demand. Okay, so they're marketable securities. And so for every seller, we got to make sure that there's a buyer. And so if for some reason we needed cash before maturity, we would just want to make sure that there's a market out there. And we take that into consideration when we're determining which bond we want to purchase. Okay, so we want to take that into consideration. We talked about some benefits. We talked about risks. Let's shift gears a bit. I want to talk a little bit about how to evaluate how beneficial the tax-free nature of municipal bonds is when we're comparing them to taxable bonds, like corporate bonds, for instance. So tax equivalent yield is important in comparing muni bonds to corporate bonds or some other taxable bond. I'm going to try to refrain from involving too much math, but I think it's important that we, kind of understand generally how we go about taking the yield from a muni bond and in effect converting it to a tax equivalent yield that we would need to earn if a bond were fully taxed like a corporate bond. And so that's what tax equivalent yield tells us. So the formula is pretty simple. You start with the tax exempt yield of the muni bond and you put that in the numerator. And then you divide that number by 1 minus your marginal tax rate. Okay. The marginal tax rate, of course, is different for different people. And, as you'll see here shortly, your marginal tax bracket is very critical, in determining whether muni bonds are a good fit for you. So understand that we can't compare a muni bond and a corporate bond and evaluate them in a vacuum and say definitively that muni bond A is better than corporate bond B for any and everyone, right? Because that evaluation might be different for different people based upon their, different marginal tax rates. So the outcome for two different people evaluating the same bonds might be completely different based upon their marginal tax bracket. So, okay, so let's take a look at an example where we can put some numbers to this and make sense of it a little bit better. So, okay, so again, we're going to start with the tax-free muni bond yield. If we can go to the next slide, please. So in this case, that's 5%. Okay, so for hypothetical purposes, we're going to evaluate a bond issued by the state of Kansas that's yielding a 5% semi-annual interest payment. Okay, so we've got our 5% and we know that that's our numerator. Okay, next we want to identify the investor's marginal tax rate. And so by marginal tax rate, we mean, at what percentage is the next dollar of income that we generate going to be taxed at? So in this example, that's going to be 30%. So In our example calculation, we're going to divide that 5% muni bond yield by 1 minus our marginal tax rate of 0.3. And that comes out to be 7.14%. Okay, so what does a tax equivalent yield of 7.14% on this 5% Kansas muni bond tell us? Well, it tells us that when we're comparing this muni bond to other taxable bonds, that we need to get a yield of at least 7.14% on a taxable bond to get the same return after we account for the fact that we owe taxes on our corporate bond. So for the sake of discussion, let's say we're comparing a 5% Kansas muni bond to a corporate bond with the exact same rating and exact same risk, and it's yielding 6.5%. Well, in that scenario, the muni bond is going to provide a better after-tax yield because 7.14% is greater than 6.5%. Okay, so I don't have the math listed on this slide, but if we assume the same set of fact patterns, but we change our marginal tax rate from 30% to say 15%, the tax equivalent yield on that same Kansas muni bond paying 5% would be less than 6.5%. And so therefore be more prudent to buy the corporate bond for that person with a 15% marginal bracket, even though it's taxable. So two different people, two different marginal tax brackets evaluating the same two bonds, and we can come to a different conclusion. So that's why marginal tax rate is absolutely critical when we're evaluating whether muni bonds are appropriate for you. So generally speaking, the higher your marginal tax rate, the more appropriate they are for you. So again, we don't need you to be an expert on how to calculate the tax equivalent yield necessarily, but hopefully that just illustrates how important a role it plays in kind of determining whether it's a good investment for you. So okay, Trent,
Jude, I think that's the important thing to say to our listeners out there is that, hey, let us do the math. If what's going to be good for you, whether it's a corporate bond or whether it is a municipal bond, and talk to your CPA, talk to your advisor. They're going to know, and they're going to be able to tell you, hey, our municipal bond's a good fit for you. And so, like we talked about, there's going to be different risks with different bonds, whether it's Walmart issuing a corporate bond or whether it's the state of Kansas issuing a municipal bond. And so, again, just have that conversation. Feel free to bring it up, and let us do the math, and we'll walk you through that because municipal bonds are going to change, interest rates are going to change, what's even available is going to change as far as what's being issued. And so all those factors come into play, and that's where our expertise can guide you in the right direction. So anything to add to that, Jude?
No. Let's assume for the sake of discussion that we've got someone that we think munis are a good fit for us. Trent, why don't you kind of help us walk through some strategies for how we might implement muni bonds from a practical standpoint, right? What does that look like?
Yeah. So we're going to look, this is kind of part two. We're going to look at the five different kind of ways, strategies to leverage yourself for municipal bonds, if that is something that would be a good fit for you. And so first thing is diversification. We all, Jude already touched on it about we want your portfolio to be diversified. And so now we're talking here about diversification within municipal bonds. Okay. So let's say, for example, Hays, Kansas issues a municipal bond for a new water park. Okay. And you're interested, hey, Hays is thriving. This sounds like a good investment. You don't want to go, if you have $100,000 like this example, you don't want to go probably put your full 100,000, depending on how much you're starting from, into this Hays bond. Okay. Because you're going to carry more risk. And so what we're going to recommend is that you diversify into different bonds, different cities, maybe different states, and different projects. Like when I was talking about geo bonds versus revenue bonds. And so the example here that we give is $25,000 into 4 different bonds. This is a great example of what we might do for a client. If a client came to me and said, hey, I'd like to put $100,000 into tax-free municipal bonds. And so again, we might find an issue with a very high credit rating. Hey, AAA in Dallas, Texas. Okay. We might find one for the 25,000 in Hays, Kansas, and 25,000 in Olathe, Kansas. And so this is how we diversify within individual municipal bonds. Now, I use the word individual because we're going to touch on something here different with municipal bond mutual funds. And so right now we're talking about individual municipal bonds that we could go out and purchase. And so not only are we going to diversify again within different bonds, then we're also going to talk about laddering these bonds that provides more diversification and a different strategy. Okay, so laddering bonds is going to find you're going to find different maturities within those bonds that you want to buy. So again, the same example, if you have you come to one of us with $100,000 and um, we're looking at different municipal bonds, and I'll use the same example. Hays, Kansas has a project for a new swimming pool that's 10 years out. So you buy these bonds for Hays, Kansas, and they're going to pay you back your interest, which oftentimes you hear the term coupon. That's the interest you receive back in a year. Okay. And it's going to mature in 10 years. Hey, that's a great investment, a great bond. But again, you're putting yourself at risk there, interest rate risk, other risks out for that 10 years. It's like a CD. It's like buying a CD at a bank for 10 years. Okay, there's going to be some risks there that interest rates are going to move, and hey, I might be able to get a higher yield in 2 years or 3 years. So we don't want to do that. So we're going to ladder these out into 1 year, 3 years, 5 years. Again, the same example, 4 different bonds. As that 1 year bond, municipal bond comes due, hey, what can I go find now? This $25,000 came due. Now maybe I want to go out. Hey, maybe the best interest rate is at 6 years, or maybe it's 12 years. And so that's where you work with an advisor to find out what's available. Again, what's your goal? The other way we use laddering is a lot of times people will set goals with a purchase that they have in mind, whether it's maybe a piece of land or a boat, or you're retiring in 5 years, or maybe you inherit some money and you say, hey, I need some of this money in 5 years or 7 years. We can work with you on that strategy of laddering them out to, again, meet your goal, but also provide you the best best return versus the risk you're taking. So, all right. I touched on it briefly, an individual bond versus a bond mutual fund. Jude, give us a little more description.
Yeah. So far we've mostly been talking about buying those individual bonds to get our muni bond exposure, and there's a lot of benefits to doing that, right? Trent just pointed out how the laddering of maturity dates can benefit you when you buy individual bonds, right? We have control over exactly when those maturity dates are. So we kind of know exactly when we can get paid and how much and when it will mature, and we like that control. So you using individual bonds, kind of allows us also to have control over the issuer. Okay, so we can be sure that the person that we're buying the bonds from is of a good quality credit rating, and something we're comfortable with. So lots of good reasons to own them individually, but there are several reasons why instead of owning a muni bond individually, we might instead want to just buy a mutual fund that owns muni bonds. Okay, so why might that be? Well, think about in a mutual fund, you're pooling your money with a lot of other people's monies. And so these funds are generally very, very large. Okay. And because of that, you can own hundreds, if not thousands of different bonds, which helps maximize, your diversification and really kind of limits your risk for default, right? If with an individual bond, if any one of them were to default, that would severely impact your overall return of your portfolio, right? But you'd certainly feel that. But a default of a bond held within a mutual fund that owns 1,000, might have not any or very little impact on your value. Okay. Of course, with a mutual fund, you have a professional that is managing and overseeing the fund, and they're making decisions on which muni bonds are most attractive, and they look at this stuff all day, every day. It's what they do for a living, right? And so there's value in that, certainly. So of course, the other side of that coin is that you're going to pay that professional management by way of the expense ratio of the mutual fund. So one other benefit of a mutual fund is just liquidity. We talked about liquidity risk earlier and how we have to, be sure that there's a market for individual bonds if ever we needed to sell. Well, with a mutual fund, we don't have to worry about those liquidity concerns. We can always sell at any time. So there's pros and cons to holding bonds individually, and then the same is true for muni bonds held inside a mutual fund. Trent touched on this a little bit when we reviewed diversification. But let's go to the next slide and we'll kind of review what maybe a common portfolio allocation might look like as we kind of try to limit some of those risks associated with muni bonds that we talked about earlier. So,
Jude, we had a question pop in.
okay.
Let's go to it. What is I think this goes back to tax equivalent yield. What's the easiest way to determine my marginal tax rate?
Yeah, so good question. If you're doing your own tax return, you'll have to go look to your taxable income is the number that you want to get to, and this can be a little bit tricky because sometimes long-term capital gains can skew this because they're taxed at a little bit different rate. If you have someone that's preparing your return for you, I guess I would say that reach out to them, let them answer that question for you. If you're preparing this on your own, I would start with where your adjusted gross income is and go look at, or excuse me, your taxable income, and go look at the tax rates and the brackets and see where you're at. And wherever that next dollar falls, more often than not, will be what your marginal tax rate is.
I think that's good. Yeah, ask your CPA, or if you know where to look. And I think the important thing here to point out with municipal bonds, we often think that they're only for high net worth clients, but really, if they might be, from just a diversification standpoint, they might be a good fit for you, even if you're maybe in a little bit lower tax bracket. Just as interest rates move, or maybe, hey, maybe I'm taking too much risk here in corporates, and I do want to add in some municipals, because there's times when municipals are going to, the interest rates are going to be different. They're going to move and potentially, do very well for you. And like we touched on, also, they're going to be less risk than your corporate bonds or your equities.
Yeah, good point. This isn't just for people in the highest marginal tax rates. A lot of times it's more beneficial for them, of course, but it can be used for people in a lower marginal tax bracket as well. So, okay, did we get it answered, or do we have more?
I think we're good. Go ahead.
Okay, so let's talk portfolio allocation. This is maybe a little bit duplicative, but this is kind of just an example of how we can use 5 different ways of gaining exposure to muni bonds that are all a little bit different. Okay, so the reason is that we want to help maximize some of the benefits of muni bonds and kind of try to minimize the risk that we already talked about. So we diversify not just within our overall portfolio, but even within our exposure to muni bonds. So in this example, the first 3 bonds are individually held bonds. So as you can see, we've got the first one for $30,000 with a very high rating. Okay, that's a GO bond. We've got the second one that's a revenue bond, so a different type of muni bond. And then the third one where we used one from a different state, so we have a little bit of diversification from a geographical perspective. So the bottom 2 are mutual funds. Okay, so one which is shorter in duration and maybe potentially less sensitive to interest rate changes over time. So and it's very liquid. And then we have one that's longer and maybe has a higher yield because of that extended duration. So suffice it to say that even if we like muni bonds and they're a good fit in your particular situation, allocation is critically important. And it varies based upon what your investment objective is and what your risk tolerance is and what your liquidity need are and all that thing. So okay, so last thing I want to touch base on here is relating to the tax-free benefits of muni bonds. Earlier we mentioned how the interest is federally tax exempt, and I mentioned that there's also the potential that we for them to be state tax exempt as well. So I guess what then is the determining factor in whether you owe state tax on your muni bond interest? Okay, the answer is where the issuer of the bond is located relative to where you reside. Okay, so for instance, if you're a resident of Kansas and you buy a state of Kansas bond or a bond issued by the city of Wichita, for instance, you don't owe any taxes on your muni bond interest because you purchased a bond where the issuer is from the state that you reside. Okay. If you happen to be a resident of Arkansas and you buy that exact same bond issued by the city of Wichita, you do owe the income tax to the state. So where the issuer is located can be an important factor when we're, Trent and I are making a determination on which muni bond to purchase. So this example kind of just illustrates what we've talked about with some of the numbers, right? Okay, so we have a $100,000 bond. It's earning a 5% yield. We know that we're going to get $5,000 of interest each year until maturity. In this example, our marginal tax rate is 34%. So we're going to save, $1,700 in federal tax by owning this municipal bond that, otherwise we would have paid if the same bond was a corporate bond. And then the same thing with the state in terms of we made $5,000 of interest income. Our marginal tax rate 6%. And so this example assumes, the issuer of the bond we purchased from, we were also a resident of that exact same state. So we saved $300 in state taxes for a total of $2,000 of tax. Okay, so that's real life savings of how incorporating muni bonds into your portfolio can save you income tax today. And so, it's definitely something we want to consider when we're trying to determine an appropriate portfolio for an investment client. So, okay, Trent, you want to bring us home?
Yep, let's circle this around. I think we got a couple questions in the queue. We'll get to here at the end. This is the last slide, and so what can we do to take advantage of this? Okay, and this first point here, lock in higher yields. That kind of goes with the first question we'll touch on here, but right now interest rates are high or as high as they've been, and we know they're going to be, we think potentially they're going to be coming down. Okay, this is that opportunity right now. We really like municipals right now. You might have to go a little bit longer out to get the yield you want, 7 years, 10 years out, but you can lock in that higher yield than you can in 6 months or a year from now. So that's one way. We talked about diversification across maturities. You might have to go longer out on the curve, like I just talked about, to get the yield you want. But again, we want to diversify. Credit quality. If we're doing individual bonds, we always stick with investment grade. I've never done an individual bond that's been below BBB. And so find good quality bonds, whether they're Kansas, Texas, Utah. There is some areas of the United States that we shy away from. And maybe we don't want to buy a bond there like Detroit, a few years ago or somewhere else. So you think about the risk just with a hurricane coming in just recently. Maybe if you have a North Carolina bond, there's going to be risk there. And so you want good credit quality bonds that are diversified. Reinvestment. This is a good way to, that interest that you receive, take that and whether you buy it, whether you're going to take it as income or whether you're going to buy back into more municipal bonds or into a bond fund, that's always a good strategy. Diversification. And then 6, monitor market conditions. This is right now, we're very mindful of what's going on, not only with the Federal Reserve, but with the upcoming election and administration changes. Possible tax changes could be coming down the road, and so you definitely want to keep an eye on market conditions, because those type of things will affect interest rates and are going to affect municipal bonds and just the availability, the supply, all those type of things that you can think about. So, all right. That sums up our slides. We got a number of questions here that we want to get into. So we got about 15 minutes here left before the top of the hour. The first question that came up, thoughts on purchasing bonds in anticipation of interest rate cuts and sell them to make a profit on the price going up rather than waiting for bond interest payments. I'll touch on this one, Jude. Um, this is a pretty high level question, and I understand the premise because, like Jude said, interest rates go down, bond prices are going to go up. So a bond is usually issued at $100. Okay. So if interest rates go down, that bond price might go up to 104, 105, 108. But let's say you're getting a 5% coupon. Okay. So you're receiving 5% a year tax free. Okay. To use the strategy to say, hey, I want to go out and sell this now and take my gain because I think interest rates may go back up, or I need the money now. One, you're opening yourself up to potential capital gains. Okay. But my thought is, one, we usually buy municipal bonds for the income. Where are you going to go with that money then? Interest rates are lower. Are you going to go into equities? Are you going to, so again, it's talking through. I do understand the strategy. I've never really done it for a client because usually they're really happy receiving 5% tax free and they want to continue on with that. So I hope that makes sense. Again, talk it through, talk to your advisor. It's a little bit more of a timing strategy that can be tough. All right, question 2. Next question, Jude. What is the typical fee for short-term and long-term municipal bond funds?
Oh, okay. So, that obviously can vary from fund company to fund company. I mean, I guess, and I don't know, Trent, feel free to jump in. I guess I would say, generally speaking, somewhere from maybe a 0.5% to 1%, is probably what you're going to pay a money manager in a mutual fund.
Yeah, there's active municipal funds versus more index, which you can get a lower cost. There's some short-term bond funds that you can use that are down around 20 basis points. But again, you want to look at the quality of the bond mutual fund. How much of it's investment grade, what's the coupon. So there's a lot of things to look at besides just the expense ratio for that fund. Okay. Jude, does your firm recommend specific bond mutual funds? Are we going to plug anybody's name here and give them?
I don't know that we want to. I don't know that we want to recommend specific, bond funds because my concern is that what's good today might not be good tomorrow. Just know that our firm, we have a vetting process, I guess is what we would say, and so we're constantly reviewing these, different companies that offer these bond funds, and we're evaluating them, and we're looking at performance. We're looking at the composition of these funds. We're looking at expense ratio, right? We're taking it all into consideration. And so to be fair, what's good today sometimes isn't good tomorrow, and we've made changes for those various reasons. So I don't know that I'm going to recommend any one particular today, but yeah, we have ones that we like more than others today, for sure.
Yeah. And we're continuing to review those so yeah, talk with us if you're interested. We'll give you some names. All right, next question, Jude. What if we purchase a bond and we sell it due to appreciation? Oh, my question moved on me. And interest rates dropping, is that event taxable? I touched on this a little bit, but go ahead.
Yeah, so assuming we're talking about an individual or a joint account, the answer is yes, right? And so keep that in mind. If you sell your bond, that is a taxable transaction, and how it's taxed will depend upon your holding period. Okay, so we want to make sure we've given consideration to when we bought the bond and when we're selling it. Okay, so there's tax advantage rates for owning securities more than 1 year. And so all things equal, we prefer to wait if we can, but understand that sometimes, that price appreciation can motivate us to make changes, even if it means a little bit of tax.
Yeah. Good answer. Yeah. Talk to your CPA, talk to your advisor about that, what the taxable consequence may be. All right. Next question, as the questions continue to roll in. Thank you, everybody, for the questions. We appreciate it. We usually don't get this many. Are the rates set at the time you purchase the muni bond, or do they change over the duration until maturity? I'll answer that question. So I think they're referring to the coupon. Um, I'll use the example. I just did a recent bond out of Texas. It was a 5% coupon. Um, and so I went out 10 years to 2034. That coupon, that 5%, as long as that it was a GO bond, as long as that municipality continues to pay out that interest and they don't default, right? It's not going to change. It's set at 5%. And typically, I know there can be some rare instances where coupons can change, but that's really, really rare. So for most of the time, those coupons, that interest you're going to receive per year, don't change. Now, there's another level to this that we didn't talk about. Some bonds are callable. And I don't want to get too deep here, but what they can do is, hey, they can pay out the debt. Maybe instead of over 10 years, 5 years comes up, and there's a time frame where they say they're callable, and they're going to pay out the full bond. And at that time, you would get your money back at par, which means at 100. But that again, the coupon, what you do then is you got to go find another bond, or figure out what your strategy is then. So okay, next question. How do Kansas munis compare to other states, Jude?
Okay, yeah, I mean, I don't know what context we're comparing. I guess I would say all things equal, just in terms of the number of bonds, right? The amount that you'll find available within Kansas will be significantly less than, say, a California or a Texas or a Florida or a New York, right? Those you're going to have way more options. Just in terms of rates, I would say, they're competitive, and relatively so. Um, but one thing to consider is just the number of options that you have within Kansas is significantly less than, say, if you live in California, for instance.
Yeah. Kansas's bonds are usually higher rated, but they're also a little bit harder to find, right? We don't have the biggest population. We don't. They're good Kansas bonds are just going to be harder to find, and they might not be. Might not have a credit rating. If you find a small city in Kansas that's putting up a new firehouse for, I don't know, $500,000, those we got to talk about supply then, because there's only a um, $500,000 available for that issue. And so those are things to think about within your Kansas bonds, out of state bonds. So good question. Next one, what are the penalties for early withdrawal from a municipal bond? So I'll touch on this one, Jude. I think they're referring to individual bonds. And so there's not going to be a penalty per se that they're going to take out 10% or 5%. It's going to be, we would have to go sell that bond on the secondary market and find a buyer, and whatever price they're willing to pay at that time is what you're going to get out of it. So no penalty. It's just you're giving up that bond at that time. And so I hope this makes sense for early withdrawal. Again, we normally, if we're doing individual municipal bonds, we're buying them to hold them. And I don't ever really have anybody selling individual municipal bonds, though it may happen. Bond mutual funds, like we talked about, there's not going to be a penalty either. They're fully liquid. So next question, can you please cover the difference in taxation when purchasing an in-state versus an out-of-state municipal bond? Jude?
Yeah. So, I live in Kansas. Trent lives in Arkansas. Okay. We go by the same $100,000 bond issued by the city of Wichita. Okay. It pays $5,000 for us in 2025. Okay. I'm going to pay no income tax at all because Wichita is in Kansas and that's where I live. And because of that, I pay no income tax in addition to no federal tax. Trent, on the other hand, is going to have to pay income tax to the state of Arkansas because obviously the city of Wichita isn't in Arkansas. Okay. So where you reside and where the issuer of the bond is from will determine whether or not you pay state income tax.
Yeah, that's a good point. And sometimes out-of-state bonds may have a higher yield than Kansas bonds. I find that often. Even receiving the state Kansas tax exemption, it might be more advantageous for you to go outside of Kansas and pick up a higher yielding bond, so that's always something to consider. All right, two more questions to go. Thank you, everybody. How do you determine if bond funds are tax exempt at only federal level, or if they are exempt at federal, state, and local? And I think we've touched on this. And so this is, again, if we're talking individual bonds and they're issued by the state of Kansas, and you file a tax return in the state of Kansas, they're going to be taxed at the federal, state, local level. Okay, like we talked about, if you live in Arkansas or Missouri and you're buying a Kansas bond, then you are not going to receive that state tax exemption. You'll still receive the federal, but not the state. Okay. Last question, Jude. How liquid are municipal bonds?
Okay, so yeah, let's differentiate what we're talking about. Two ways to own them. First is individually, right? So you go buy an actual bond. Liquidity depends upon the market for them out there, right? So again, the market for the state of Kansas issuing a bond is going to be much, much bigger than if the city of Victoria in Kansas issues a bond, right? So how liquid they are is a function of what the market is out there for them. Okay, so that's going to vary depending on what type of bond you own, and that's something to consider when you're figuring out what you want to buy. If we own it in a mutual fund, of course, we can buy and sell daily, right? So no concerns for liquidity if you own it in a mutual fund at all.
Good job. Thank you, everybody. For no more questions have popped up for joining in today. And Jude and I, we really like this topic and had a lot of fun with it. And we hope you learned something here today. And if you got further questions, please reach out to one of us, reach out to another Adams Brown advisor, or reach out to your own advisor if you work with somebody else. And we're more than happy to visit with you about this topic about municipal bonds. Anything to add, Jude?
No, I'm good. Thanks.
Thank you, everybody.